Hello, this is the Chartprofit video. We're approaching 3.5 hours into the trading day on Friday the 26th of February. This is an hourly chart of the E-mini S&P in black and oil in red. You can see very clearly the oil continues to be the main driver here, a very close correlation on this chart. If we zoom in here, this is light crude futures current daily chart, and we've been looking at the halfway point here as a guide to strength weakness across this range. So this week we've possibly seen off this low here a higher low on that halfway point just here. Once it's carved out that pattern, really wouldn't want to see price back under here again if we're going to go higher here, and if we do that, we'll be bullish for equities. So let's have a closer look at the S&P E-mini. As you know, the big level, previous major point of control is this 1870 level, which is down here. And since mid-February this month, we've seen all of these value areas here printed above that level. And I take that as a strong price location indicator of strength in the longer term. As long as we hold that level, price down here would not be good. We identified a first level support at 1886.50, which is the 70-day point of control, which is here, and it appears again like oil that we've formed a pattern which gives us a higher low against that level, actually exactly there. On Thursday we had aggressive buying up here, and we've seen some improvement, certainly for New York, in the breadth numbers here at 56%. So there's definitely improvement this week. It's been a pretty good week, pretty constructive for the market. So this is the daily breadth chart through Thursday. You can see these two indicators that we follow week to week down here, day to day, above their levels, which means the pulse chart has improved on the breadth here. So we're getting some green. We're moving out of this long period of red or neutral into something which is showing us some green or positive readings, and the breadth at long last, the momentum at long last, price momentum, has come through and is now heading up above zero, which is usually a positive indication, and we are getting green here and here above this 187 time support. So this is a much improved pulse chart. So if you look at the daily chart here, current for the E-mini, we can see that 1870 time support here. As I said, price back below here would strongly indicate a retest of the low. We're way above that at the moment. If we close today above the high from Monday to Wednesday, we get a bullish weekly structure, which you'll see in the ebook if that happens. And what we're seeing here is a probe actually just above the halfway point off last year's high to the low here. So this is the halfway. This is the natural resistance described in the pre-open 1956.90. We have probed above it. We're currently back below that level, but acceptance of price above that level would be strong or stronger price location than we're currently in at the moment. Probably getting a little overbought here on the indicators, like this stochastic derivative at the top here. If we're in a bear trend, we could well see the market heading straight back down, but what we want to see is, we'd like to see it staying overbought up here, and preferably the E-mini holding that halfway point. Okay, this is the spider chart here. Let's look at the equivalent levels. 187.20 point of control down here. Obviously we're back above that. Earlier in the week there was a higher low here, 189.60. that's the 3-month, so that's pretty good price performance. As we saw on the pulse chart, it's the same chart actually, the momentum is now above zero and heading higher. But we have this natural overhead resistance here at this halfway point, which we've yet to test on the spider. Okay, here's the diamonds chart above its major point of control at 164.25. This red line here, currently probing above the half range resistance, printing almost exactly at that level. So next hurdle is this resistance, and price printing time above that level would be bullish, but as long as we hold 164.25, it's in a strong price location. We've also been watching the Qs as a key chart, and that is printing in a strong price location above 101.30, which is the major, and above its halfway point. Chart of the four, which is relatively the weakest, is the Russell 2000 ETF IWM, but printing above its 3 month. That's the most local time support resistance level I can find. Just this 3 month level in here. We're printing above that. Just over the last few days, it's put in a good performance here, relative, and you can see that it's on its high for the week. Good to see the small caps performing, at least in the short term, relatively, as well as the large caps. You can see that the overhead resistance, the halfway point here, and the major point of control is quite a bit higher. Both of these levels quite a bit higher up here, and if we were to see a strong rally over the next few weeks, my guess is that one of these levels would be major resistance, most likely this level here, the halfway point. Quickly look at the European markets. This is the FTSE 100, UK FTSE 100 index. I had this level marked for a long time. 58.70 is the major, and again a higher low at that point and a strong close for the week. So this chart looks a lot healthier than it did a few weeks ago. And on this chart, the next level of major resistance is this halfway point up above 6,300. If we see price back down here, that would obviously, from this proven level, be a strong indicator of weakness should that happen. And this is the German DAX. The major level here is 96.65. This red line, that's the major from the 30-minute chart, and that may well prove a problem. So I have weaker price location for the German index than the UK or the US. So a number of these charts, the spider, the halfway point, this point of control on this chart may be resistance going into next week, should we see the market a little higher. But a strong couple of days would give us price up here, and that would be a good positive indication. We'll look at some of the supporting charts. This is the 7 to 10 year bond ETF IEF. As we know, we held this level, the major point of control. We consolidated, broke out between these two to a new high actually. And in the short term, what I'm doing, just following these minor halfway points on these charts, on these bond charts, off the high. Currently printing down below that halfway point. So in the short term, this is weaker price location. In a short term minor higher low like that would be bullish, but currently we're in a weaker location here. And if we switch to a weekly chart and look at this stochastic momentum at the top here, you can see that even on the weekly we're overbought. Even in a strong uptrend, that crossover here from above overbought usually gives us at least a period of consolidation. Gold has been rallying strongly, and last week the major moved to this level at 115.50, and I said that's going to be a good level for support. Price back below that level would be a concern for the gold bulls. And again, the weekly chart, viewing this indicator again on the weekly, has reached that level of overboughtness, let's say, which has led to, well, over the last 2 or 3 years has led to resumption of the downtrend and an end to any kind of correction that we've seen. So this will be a good test. The fact is that we are actually printing now. What's different about it, we're printing above this migrated major point of control. So this is definitely stronger price location. But because of this, if we see price back underneath 115.50, we probably see prices heading lower. Before we look at the currency charts, I want to look at the sentiment. We follow the Ridex assets ratio, or my version of the ratio, each day in the pre-open. We know that 1 week ago the ratio hit 2.64, fell as low as 2.64. That was the lowest since November 2012. And Monday this week, the bear fund assets that I follow reached their highest level since late 2011. So this is the bear fund assets that I follow in isolation. This was the peak that was exceeded this year, the highest since November 2011, and at that point, and there still are lots of bears, and this is often fuel for a rally. And this is a chart that I showed last week of the bull fund assets in isolation. We're just looking at this level here, and each time that the assets have fallen below that level, it's usually corresponded over the last few years to a significant low in the market. So if I update this chart to this week, it looks like this, and you can see that we are rallying obviously in price here, but the bull fund assets are slowly moving higher. And I've said today regarding the ratio, the 3.21, which is the latest, is a 7-day high, with the spider at a 32-day high, so the Ridex traders have little faith in this rally, and I just remind you this is a contrarian indicator. Be more concerned if the ratio was accelerating higher really quickly as the Ridex traders pile back in. They're not doing that at the moment. Just updating you here on the public poll from AAII. Bulls percent was higher this week at 31.2%. 6 weeks ago, which was here, the Bulls percent fell to 17.9. That was the lowest reading since 2005. Bears percent this week was lower at 31.4. But 2 weeks ago, just 2 weeks ago, here, the Bears percent reached 48.7%, which was the highest since April 2013. And you can see the moving average of the net here, Bulls minus Bears, the 4-week moving average in black. At this point here reached an extreme low level. Investors' intelligence this week, the Bulls percentage sharply higher at 34.7. 2 weeks ago, the Bulls percentage fell to 24.7%. That was the lowest since 2008. That was significant. Bears percent 35.7. That was down from just the previous week's 39.8 just 1 week ago. That was the highest Bears percentage since October 2011. 4-week moving average of the net Bulls minus Bears reached its lowest level since 2009 just 1 week ago in here. And the exposure index, which measures current equity exposure of active money managers, we know 3 weeks ago the number reached 22.41, which was the lowest since October. Since here, anything below this line is usually overdone. There was a rally previous week, but this week that number actually came lower again at 31.65. So we're having a good rally at the moment, but active money managers are slow to increase their equity exposure at the moment, and again historically this has proven to be a contrarian indicator. Finally, the Lipper US fund flows reported equity fund including ETF outflows of 2.8 billion net in the week to the 24th of February, and the 4-week flow here in black currently in a pretty low position here. This indicating that the retail investors, like the Ridex indication, very slow at the moment to join this rally. Okay, finally the Forex charts, the most interesting I think at the moment, the Australian dollar. There's been no change here, but we did see the 12-month just recently migrate to this level here at spot 71, which is approximately this halfway point across this range. Seems to be being drawn back to that level at the moment, so this is kind of value, if you like, over the last 12 months. And price below that level would be weak price location, and time spent below there would suggest a retest of this low. So if you're bullish on the Aussie dollar, you want to see this level hold and possibly a higher low. We'll have to see what happens there. Weakest chart at the moment is sterling. This is the pound dollar. Over the last few months we've noted that this whole band up here of major resistance was probed last year. This was the low at that point, and we were tracking the halfway point from here to here, which was here, and then we had this lower high which triggered this acceleration down. So this is the weakest chart. Concerns about UK's position in Europe, some real nerves here, so we're on to a new low for this move. A dollar strong in this chart. And the two interesting charts are the Euro FX chart here and the dollar index. The Euro FX chart, or the euro against the dollar being a large component of the dollar index, and some interesting levels. This level here at 112.41 is a major half. We probed above that. The next level is the half range off this low to this high, which is here, and we've dipped below that this week, moving it into a weaker price location. I've been saying in pre-open that the 12-month 1.0925, which is here, this support. If we see this broken, and we are currently printing at that level late in this week, if we see price printed below there, I would suggest that that indicates a retest of this low. That would obviously be a good positive indication for the dollar index, which is here. Now, as you know, this level here, 95.22, was the 12-month point of control, and that supported the chart at that point just a few days ago. The index then printed back up above this halfway point, which is an indicator of strength. But what's happened this week, and this is something that we've talked about and considered the possibility that this point of control, which is now the 24-month, would move higher, and that's actually what it's done now. So just in the last few days we've seen the 24-month migrate to 97.40. Now if the dollar index can now hold above this level, I'll be looking for a new high here. We know that migration of a point of control of some importance often precedes a directional move. So we've seen this move higher, and not necessarily bullish, but as long as we see price holding above that level, consolidating, it can suddenly start moving, and that could be to a new high, I think. So this is something we'll monitor going into next week, and the implications of that. Okay, that concludes. Once again, I wish you a good weekend, and thank you for watching.